Welcome. This video is designed to provide you with valuable information on the topics of wills and guardianship. The focus of the channel is on British expatriates living in Dubai. However, the content will be useful for many other people too. I'm Stuart Porter, founder of Great British Wills and your host. Please remember the following is only intended as information. You should seek the services of a qualified will draftsperson before taking any action. Probably the best way to demonstrate how a will saves tax is to use an example. Anne and Steve are British expats resident in the UAE. Steve owns 2 investment properties in England worth a total of £1 million, an investment portfolio valued at £750,000 and various bank accounts containing roughly £250,000 in cash. Anne has no assets and is a full-time mum stroke taxi service for their 2 children, Angela aged 12 and Robert aged 15. They have no will in place. Steve and Anne want each other to benefit from the whole of their estate in the event of the first of them to die. Then, when the second spouse dies, their children, Angela and Robert, are to benefit equally, a common structure often referred to as a mirror will. As they have no will in place, the rules of intestacy would apply to their estate on their deaths. These rules are effectively a will prepared by the country in which the assets are located. These rules determine who should benefit from their assets in the event of the death of the owner. The properties owned by Steve in England, investments and any bank accounts would not be distributed according to his wishes. Under the rules of intestacy for England and Wales, the first £270,000 of assets would be given to Anne, his surviving spouse, and 50% of the balance above this figure. The remaining 50% would be given equally to his children on their 18th birthday. As they are currently under the age of 18, a trust would be formed holding their inheritance until they come of age. This distribution would incur an inheritance tax charge of roughly £140,000. I'm often asked whether inheritance tax is only charged on assets in the UK. For most British expats, this is not the case for the following reason. Most Brits resident in the UAE are non-resident for UK income tax purposes. However, death duties are based on a different legal concept called domicile. It's difficult to change your domicile. Long-term residents in the UAE are often surprised to learn that they remain UK domiciled despite being overseas for many years. If you are UK domiciled on your death, your worldwide assets are assessed for UK inheritance tax. So that includes any assets you have in the UAE and offshore, as well as those in the UK. Where both spouses are domiciled in the UK and assets are gifted to the surviving spouse on death, inheritance tax is not charged on those gifts. This is because it's an exempt transfer. With few exceptions, the amount which can be gifted from the estate before incurring the tax is limited to £325,000. To be clear, if the total value of worldwide assets of a UK domiciled person is greater than £325,000, inheritance tax may be an issue. There is no will in place. Steve's assets will be distributed according to the rules of intestacy. The children's share will be reduced by over £140,000 due to inheritance tax, money which Anne could have used to support their lifestyle and education. Having a will in place which sets out Steve's wishes would avoid this tax being charged on his death. Additionally, Steve probably has many years left in the accumulation phase of his life. Consequently, the situation is only likely to get worse as the value of his property portfolio and other assets rise. Thank you for watching this video on how a will can save tax. I hope you found the content useful and informative, and if you have any questions, please give me a call on 050 594 5217 or check out my website greatbritishwills.com for more information. Initial calls are free of charge and without obligation. I look forward to hearing from you.